Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, April 22nd, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday expanded edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at the key levels for next week, and update. But not this week, not updating the 21 over 21 list. We're going to go through it and see how it was decimated, and we'll be dropping. It's like an execution online or live. We're dropping stocks from the 21 over 21 list, and you can tell just by looking at the screen and how much red is on here that it's pretty apparent why. So checking over here at the trend gauge, you can see we've downgraded everything to correction. This started yesterday with some very severe selling of the last sectors that had been holding up, closed on the brink of a breakdown in the NASDAQ 100 and on the S&P 500, and a certain severe break of that last level of support today firmly put us in the correction camp across short-term, medium-term, and long-term, and also market leaders. And you can see our overall market state change to correction. So what happened today, as I mentioned, severe break of support, very red here on all of the key indexes that we track. Our G6 down 2.75%, S&P down 2.8, NASDAQ 100 down 2.6, Dow down 2.8, Midcaps down 2.7, Russell down 2.6. Diversified 60-40 global stock and bond down 1.43, GROTECTION down 0.24%. We got most out of the way yesterday. Stops hit on our final positions earlier this morning, pretty much out of the gate, so we avoided most of the carnage. Let's dive right into it. Going through the charts of the indexes, the tail of the tape, and dropping stocks from the 21 over 21 list if you're interested in this approach. Trend following is what we do. Uptrend, we are in the market. Sideways trend, we reduce exposure, lock in profits, and are quick to sell anything that is lagging, and get a lot more picky on our exposure to the market. Downtrend, we get the heck out of the way. And when you get the heck out of the way, this is called crisis alpha. This is part of our process. When you recognize that you can get out of the way, get mostly to cash, and you see severe breaks in the market that you can avoid, this is part of why we outperform big time during bear markets. And again, if you're interested in this approach, reach out to us. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com. Or call. Danny will answer the phone, 855-REAL-WEALTH. That's 855-732-5932. Make sure you check out our podcast this weekend. We talk a lot about average true range and how important it is to our process. So let's get to the charts. Here's your S&P 500, very clear. Let me blow this up a little bit. Very clear. So yesterday morning on Thursday morning, we had a gap up on Tesla, worked our way higher up through the 200-day moving average, and then about 10 o'clock we fell out of bed. Tesla broke its opening range lows, and the S&P, really every index just was in a free fall for the rest of the day, and that followed through today. And it's not what I want to call capitulation selling. Capitulation selling is a bar that looks like this. It happened on January 24th, and it happened on February 24th, which is you have several days of selling to the downside, and then a big capitulation volume candle to the downside. Usually you get around 9 to 10% to the downside exposed from the 50-day moving average, and then you snap back, and then you try to repair the damage. So this was the first leg down. We rallied a little bit, stymied by the 50-day moving average. We had our second leg down and had another capitulation event. Again, here's 3-4 down days, after you fail on a rally, and then a big move lower. We were again down 8, 9, 10% from the this red line, the 50-day moving average, and then a sharp snapback. Tried to work higher, tried to sell off, but never broke the lows of that day. So we were looking for this to be maybe. Very often corrections have 3 legs down. This would be the first one, rally. This would be the second one, rally. This would have been the third one, but it held. Then we saw a pretty nice tradable rally. We got our exposure back in, but then it failed. We couldn't get to new highs, broke back below the 200-day moving average. And now I would look at these first 2 days as being similar to this period here toward the end of February and this period here toward the end of January. This is not the end of the selling today, and I say that because of this picture right here. This is not fear-based panic selling. This is a slow churn, death by 1,000 cuts, trickle down lower, a little bit of an attempt to rally after 3 o'clock, but then rolled over and closed near the lows of the day. This is in no way, shape, or form a capitulation event where everybody just threw the baby out with the bathwater. This is controlled selling. Started at the top with this gap up on Tesla earnings, and which failed badly. And look at, here's the NASDAQ 100, very similar intraday pattern, controlled selling, not a lot of big spike ranges until this little flurry of activity toward the end of the day that failed miserably. Dow Jones Industrial Average, not isolated or insulated either from it. Selling all day, finished at the lows of the day. Mid caps, same situation, selling. So selling across all sectors, across all market caps, across all sizes. Stocks, really, there was absolutely nothing spared over the last couple of days. Pretty much everything got hit. Well, let's say 99% of everything got hit. And here's small cap, same thing. Let's go to the daily charts and you can see how we are below all moving averages. The red line, the 50-day, that's our intermediate term trend. The green line, the 21-day, that's our short-term trend. The black line, that's our 200-day long-term trend. Haven't broken lows from January and late February and March. So, like I said, these last 2 days were just really control selling. It was, it's called hit the bids, which is when somebody puts something up for sale, they get out and you're not buying on the offer, you're selling on the bid, and the market makers get to pocket the difference. MDY broke all moving averages. Dow Jones Industrial Average on the daily chart here breaking all moving averages. NASDAQ 100 breaking all moving averages, and of course the trusty old S&P 500, 11 out of 11 sectors down today, as you'll see when we go through the tail of the tape and dive a little bit deeper in a bit. So what are we looking for next week? Well, as I mentioned, we're all in cash. Got stopped yesterday on probably 3/4 of our stuff. Well, let's say at the end of the day, we are at an effective beta, adjusted beta of about 0.7 by the end of Wednesday. 2 days later, we're at 0. We started the day today at 0.2, so quite a bit of it stopped out on Thursday, small losses or mild or minor gains locked in, and avoided most of this train wreck today. We know when to step off the tracks. So we'll take a look at the tail of the tape and some key levels. The only thing on my screen that I tracked that was up today was the US dollar, and this is part of the problem. Strong dollar is not good for stocks, especially not good for domestic stocks in the US. So let us go to, I'm going to bring up the tail of the tape here and stick back on the S&P 500, and you'll be able to see from all the red here. So went to a correction. We still got all the headwinds to deal with. Put call ratio, this is the highest level it's been in quite a while, but it can go higher. It can spike higher. So the put call ratio spiked, but there wasn't insane volume and panic selling that happened today. The VIX up 24.4% on the day to 28.21. Fear and greed dropped to 41, down 5, and now in fear, but quite a bit away from extreme fear. And this can go all the way down to single digits. If you think that the worst of this is over, we don't predict here, but we can tell we have expectations based on what's going on in the market, and our expectation is that this is the time to avoid, and we would expect lower prices. Back to a bull case where we're looking for some maybe capitulation and to reclaim some short-term moving averages and initiate a rally, but I don't think we're anywhere near close to that. Bear case, this is where we are right now. Rally failure, break of moving averages was confirmed on 414 and definitely with an exclamation point today. From the news front, nothing of note. Levels I was watching coming in today was how or if we were going to be able to hold these key support levels, and severe break of both of them on the S&P. This 43.85 finally gave way, and this 338.22 fib on the NASDAQ 100 broke it yesterday, severely moved further down on it today. So action, we followed up a weekday on Thursday, opening down 0.3%, but then the all-day frozen slope. A frozen rope is when you're trending up in a tight range. We'll call a frozen slope. What that looked like on a 5-minute chart on all the indexes, just a trend down all day long, close near the lows of the day. Like I said, the only thing positive, the US dollar, some things started strong on the day, oils, fertilizers, and steel, but they turned tail and finished negative. XLB and XLV were by far the weakest of the 11 sectors, but all 11 were down on the day, and gold, silver, and gold stocks continued to get hammered. So I want to take a look at XLV quick. This is one of the sectors we were in that we got stopped out right at after the opening today, because this had been holding up, gapped below the 21. Some really bad earnings reports in a couple of sectors put the final nail in the coffin of the healthcare sector. So back to the S&P 500 and the tail of the tape. I mentioned we're all in cash now, zero exposure. Bottom line, market and correction back to all cash. You can see all these levels here that have been broken over the past 2.5, 3 weeks, as displayed here on this chart. 200-day moving average, when you're below that, that's when risk picks up. That's where we are again. So let's get to the 21 over 21 list, and this is, I really didn't see any point in rebuilding it because of how severe the breaks were, and I don't even know if I can get to 21 decent looking charts that were liquid enough and are attractive enough, but we're going to go, this was last week's list, and we're just going to go in order by the most recently ones added and see what's coming off the list. So CrowdStrike definitely coming off. This is one of the last tech leaders, but selling over the last week and a half. It's finished. Delta Airlines added last week. This is one of the ones that is holding up pretty well. In fact, all the airlines doing a pretty darn good job of participating in an uptrend. Caterpillar, this was something that held out great during the week with this big move up on volume off of this nice tight consolidation. This is just what you want to see in a bull market to get your money into, and all undone in a matter of 2 days. Caterpillar breaking the 21 will be off. CCJ, we got stopped on this yesterday, bounced where we needed it to on the 21 where we took our position, closed out with a small loss yesterday, and follow through to the downside today, coming off of the list. Chevron breaking the 21, along with showing some weakness finally in some oil stocks. Deere, John Deere, oh dear, like the look of this too, along with Caterpillar. This has been on the list for a few weeks, not anymore, breaking below the 21. I think we've only got one that stayed so far. Everything else is cutting off. Occidental OXY, we got stopped on this for a very small profit today. breaking below the 21. GD, General Dynamics, breaking below the 21 as even defense, the literal aerospace and defense stocks started to take some hits today. Let's see what happened here. I got my sort order off, so let's get back into this. Okay, moving on. Costco, breaking the 21. FCX, Freeport, terrible reaction to earnings, follow through to the downside, breaking the 21. Public storage sitting on the 21. REITs are holding up surprisingly well. Usually REITs do not act well in a rising rate environment, and they may really not work well if these interest rate increases that the Fed's talking about over the next 3 meetings come to fruition. But for now, it's been a place for people to hide money. PSA still holding the 21. Several other ones, especially storage REITs, continue to look fine too. Dollar Tree pulling back but still above the 21. Lantheus Holdings sitting on the 21. Halliburton broke the 21 after earnings yesterday. Palo Alto. Hey, Palo Alto, great security stock, not based on the last 2 days' action, breaking the 21 and the 50. Newmont Mining, gold stocks, this is the place to be, not the place to be after yesterday and today's action. Nucor, steel stock, big gap up on earnings, up almost 10% at one point, gave it all back and then some today, still above the 21, but man, that is a 18% reversal off of the top, kind of brutal. Arch, coal stocks, strong for a while, not strong anymore. AbbVie, 21 rolled over last week, broke to 21, reclaimed it by the end of the week. They had a key executive leave, more selling this week. CF Industries, fertilizer stocks, even those have broken the 21. Devon Energy broke the 21. So we had 3 survivors out of 21 stocks. No way I would have come up with 18 more stocks to put on here. So that kind of speaks for itself, and that's where we're going to leave this week's expanded edition. So always like feedback. Email me, don@revereasset.com, phone 855-REAL-WEALTH. In case I was not crystal clear, it's not the time to be a hero in the market based on the action of the last 2 days. So wrapping up Friday, April 22nd, this is Don Vandenbord telling it like it is, ugly though it is, telling it like it is. Just the facts here, folks. We don't tell you what you want to hear. We tell you what you need to hear. Thanks for listening and have a great weekend.